Hello and welcome to DIY Investing YouTube channel. Today we are looking at Honeywell International, ticker HON. Over the next few minutes, I'll discuss my thoughts on both the valuation of this company and its business quality. First up, they have a market cap of $125 billion, enterprise value of $134 billion. So you can see about $9 billion in net debt on this business. It's overall a pretty low amount for a company of this size. They have the industrial conglomerates industry. Honeywell is a diversified technology and manufacturing company, so there's your keyword, manufacturing. They have an aerospace segment, so they offer power units, propulsion engines, avionics, environmental control. They have Honeywell building technology segments. This is software applications, building control optimization, sensors, switches, control systems, instrumentation. They have a performance materials and technology segment. So this is automation control, instrumentation, software. And they have a safety and productivity solutions segment, personal protection equipment, apparel, gear, and footwear. So very many different segments. One thing that leaps out to me is these segments probably have very different economics. You think about the difference between, manufacturing engines versus manufacturing sensors and switches versus something that's more of like software-based, automation control, instrumentation, software. Those are very different businesses, as well as manufacturing stuff like PP&E, apparel, gear, and footwear. Those are much probably lower margin businesses, but very different economics across this business. So when they're all going to be combined, it might be a little confusing because it's not a super focused business based upon these four different segments. So one thing that I see here with return on invested capital is they have 2 years of losses in 2001, 2002, but since then they have 17 straight years of profits. That's actually a really good sign because there's no clear signal that they're going to end up losing money in a future recession. They did pretty well through the 2020, 2021 type recession. They did pretty well through the 2008, 2009 recession. So there's no clear obvious indicator that, these 2 years are going to repeat. You have 17 years in a row of profits. 3 years from now, I'm going to guess it's going to be 20 years in a row in profits, which is a good sign of a quality business. Likewise, these profits are staying pretty steadily above 10% return on invested capital. Now, it's not every year. They dropped down in 2017. They dropped down below in 2009. They had a few years below here, 2003, 2004. But overall, most years are 10% plus and ranging between 10 and 20%. That's what I like to see for a high-quality business. They're overall hitting the numbers I'd like to see. You see how that translates here. Return on invested capital averaging 15%, return on equity averaging 26%. Both of these numbers are very good. Definitely hitting the high quality business mark, which is 10% plus and 15% plus. They're doing that very easily. Now, where I would start to have concerns that although this is a high quality business, we're not seeing a lot of growth. Revenue is basically flat. Now, it is negative 0.6, but it's basically flat over the course of a decade. You see 39 billion, 35 billion here. They probably have a slightly better year, of course, 2023, based upon the trailing 12 months numbers, which is what this is going to pull in here. Despite the fact that they're not growing that much, the assets have continued to grow. Free cash flow is growing. EPS is growing. So they're still becoming more profitable over time. And I think when we go down here, you're going to see that on some of the lower numbers. So you see 10.6 billion in gross profit. They've been able to increase their gross profit despite having lower revenue. And their operating profit of 5.5 billion went to 6.4 billion. So they were able to grow that as well by about 20% over the course of the decade. And it looks like that mostly came from margin. You can see 14% operating margin up to 18% operating margin. One thing, of course, in the last video, I talk a lot about like reliability and stability of gross margins. The gross margins grew here. They're not necessarily super stable or predictable, but they did grow. That is a good way to build operating margin through the business. If you can continue to raise prices faster than your costs, you can get that operating leverage and grow the business despite that. So that's all okay, but I really like seeing top line growth. So right now I'm thinking high quality business, pretty low growth on the top line. Why is the top line so important? More so than the EPS line. Obviously, EPS is what matters. But the problem is that you can't always rely on operating leverage. Operating leverage is not infinite. You can't have operating leverage for 100, 300, 500 years. It's going to be over a shorter time frame. So you might have it for 10 years, 20, 30 years. But it's really hard to predict that you're going to get operating leverage in advance. And so I really like to depend on revenue numbers. So if I have a flat growth business and I can't rely on my operating leverage, then what this means is I need to get a cheap price. And a cheap price is something that's like PE of 8, PE of 10 type things. Even for a high quality business, if it's not growing, it's not going to be worth that much more than a low quality business. And so when I see a PE of 23 here, this is a relatively high PE. This is a PE that's telling me this is an expensive company because I'm looking for a PE of something like 8. To see a PE of 23, you're talking about being overvalued by 2/3, 3/4, something really high compared to what I think the value should be if you're not growing. Now, that might be a little conservative because I'm not giving them enough credit for this free cash flow and EPS growth, but I think it's something to be aware of. You need to be able to protect your downside. So let's look here at this EPS number, $7 here, EPS 188. So it kind of matches out that you get this PE of 23. It's important because you always want to do an analysis of the earnings, say, hey, am I being overly punishing of this company based on its current earnings? They do have 3 years in the last 10 years with higher earnings than they do today. So it's something to be aware of that maybe the earnings are understated a little bit, but it's just something to just continue to take in mind. They are paying out a dividend that's about half of their earnings, so about a 50% payout ratio. That's a good sign as well that you're going to get some of that cash, you're going to get some of that payback. You can see a PE, say dividend of $4. That's like a 2% dividend yield, something in that range. So you're going to get some of that return, but again, you're not getting a ton of growth here. I think back to the most recent video, the previous video was Home Depot, and you were paying PE of 20, but you were growing at revenue of 7 to 8%, and you still had operating leverage, so the EPS went double digits. That's a lot more attractive than something like here. Both companies are high quality, but quality is supercharged, and the value of the quality is supercharged when you have growth. If you have high returns on capital, but you can't retain that capital to continue to reinvest and to grow, then the value of it is not that high. It just means, hey, you made some really good returns on past investments, but you don't have the ability to reinvest in the future. And that reinvestment is what drives your double-digit returns for you as a shareholder. I'm not seeing that potential here. Maybe we'll see it in future parts of this with the income statement, balance sheet, and cash flow statement. If you're enjoying this video, hit that like button. Again, likes are not saying you necessarily like the company. You're liking my analysis. You want to see more videos that I produce. Hit that like button. Don't forget to subscribe. So, cost of goods sold. It is good that we see that despite revenue coming down, cost of goods sold has come down as well. That's allowed them to maintain and grow their operating profit, their gross profit, despite the fact that they have decreasing revenue. That's a really hard thing to do. So you want to be glad that the company's doing that. A lot of times, if you're having declining revenue, it can be very hard to maintain your business. Likewise, they've been able to maintain flat SG&A over the course of a decade. That's incredibly difficult. SG&A, you're paying employees is going to be a big part of SG&A, and employees want raises repeatedly. So to maintain a tight book on your SG&A requires strong management. I'm impressed that they've been able to do that here because they've been able to get all the value they could out of the fact that the gross profit is up only 10 to 20%, but they've been able to turn that into greater than 20% operating profit growth because they've been able to maintain that SG&A number to be very low. Very impressive. I'm very glad of how management has handled their income statement here. A lot of that comes down to expense reduction and maintaining expense growth to be a little low level. You do see EPS growing even faster than net income and operating profit. That is because they've been doing buybacks. You started out with almost 800 million shares outstanding at the beginning of the decade. You're down to 683 million shares outstanding. So you retired 120 million shares, somewhere in the 10 to 15, 20% range. That's giving you somewhere between 1 to 2% per year extra EPS than you otherwise would have. That's again, how do you get EPS growing faster than free cash flow? That 1 to 2%, as we see here, a 1.4% gap. That can explain that right there. So the buybacks is giving you some of that extra return. When we go to the balance sheet, I want to really dive into inventories and PP&E. And again, you can see they're not growing that much. PP&E is up about 10%. Inventory is up about 30 to 40%. So inventory is up a little bit more. But overall assets have grown about 50%. The problem here is the assets growing so much faster than your revenue. That's going to lead to deteriorating returns over time. So as we go back to our chart here, you can see how, right now that at this 12 to 13% return rate, a decade ago, they're in the 14 to 16% return. That decline in return on invested capital, of course, being driven by the fact that the assets continue to grow, but they're not keeping up on the profit line or the revenue growth line. So you're getting some deteriorating results over time. Now, some of that, of course, they are increasing their goodwill, increasing intangible assets. They've clearly been making some acquisitions that's playing into that extra assets as well. Now, long-term debt. This is actually a concern for me. If you're not growing, but you're still taking on a lot of debt, that becomes a big problem because it means that your ability to pay off that debt in the future, especially now that interest rates are rising, becomes a really big issue for the future returns of this business. $6 billion in long-term debt. You've added $9 billion in long-term debt over the course of the decade. So your debt is up 150%. Is your earnings up 150%? No. Is your revenue growth up 100%? No. Your revenue is actually down. Your earnings have grown some, but not enough to make up for the fact that you've taken on a lot of debt in order to do that. You've taken on more debt than you've grown your PP&E, more debt than you've grown your inventories. A lot of this debt is going to be a drag on the future returns of the business. I also see pension liabilities here. Now, they have been going down over time, which is a good sign. So clearly they must have frozen their pension in the past. Otherwise, we wouldn't see this decreasing number. But I don't like seeing pension liabilities on top of the other problems I'm seeing in this business. Let's go to cash flow statement. You should see basically pretty regular investments in PP&E, in that $1 billion range, matching pretty well with the depreciation and amortization. Nothing significant there. It just means that we don't want to make too many adjustments on that line. You do usually see some big acquisitions: $5 billion here, $1 billion here, $2 billion here, $1 billion here, which brings to mind, where has been the value in this acquisitions? We've not seen it in growing revenue. We've not seen it in really substantially higher earnings. So it immediately makes me think either those were a waste of an acquisition, or the business would be much worse off without those acquisitions. Immediately makes me think that the organic growth of this company is maybe negative because they've had to put so much money into acquisitions. It's almost $10 billion in acquisitions over the course of this decade. Yet it's not really brought us what we'd like to see in terms of the bottom line. And you think about it, it's just like, what are they doing with that money? Let me go back to the income statement and compare that. So you've been making a decent amount of money here. Of course, it's going to buybacks. Let's go back to cash flow. You can see these steady buybacks. They're making buybacks each and every year. That is a good use of our cash. But if you're paying for a high price for this business on that, it's kind of concerning. Like, why is all that money being spent on buybacks and that we're not really seeing it in terms of the return to shareholders there? You are getting dividends, but of course you're taking on this debt. I would much prefer that they probably pay off the debt. They stop increasing debt when the business isn't growing. And I'd be really trying to understand what's the ROI on these acquisitions, because it's a concern that a lot of times when acquisitions take place, it doesn't really pay off for you. Likewise, why are you having stock-based compensation like this on a business that's not growing? Get rid of that. Just pay cash. If you're having to attract employees with the stock-based compensation, there is a little bit concerned that we're not seeing that in the results. So for me, I'm going to pass on Honeywell International. What I think this is a high-quality business with no growth. And without growth, you can't harness the benefits of being a high-quality business. So I think it's a mistake to pay up for a high PE of 23 on a high-quality business just because it's high quality. You need growth to leverage that. You need growth to take advantage of this return on equity and return on invested capital. Without growth, these are almost worthless. And so for me, I'm passing on Honeywell. If you enjoyed this video, hit that like button. Don't forget to subscribe. Ring the bell so you get notified when I upload new videos working through every company in the S&P 500. If you want to learn to analyze companies like this using the software I'm using, it's quickfs.net. My affiliate link is the first link in the description below. That link will take you to the website. You can get a free or paid account to do the same analysis I am. Do quick analysis on companies. Please use my link because that's a great way to support the channel. I get a commission when you sign up using my link. Thank you for listening. Until next time, stop paying fees, start building wealth.